Great. Well, I'd like to welcome everyone to our third webinar of 2015. Thank you so much for joining us today. My name is Jessica Alfaro, and I'm a manager at CapPlus Exchange. And based on the overwhelming response we received to the early warning session at this year's Credit Risk and Problem Loan Management Workshop in Goa, India, CapPlus Exchange and CRISIL Risk Solutions are proud to present this webinar that follows from one of the best received sessions at this forum. CRISIL Risk Solutions provides a comprehensive range of risk management tools, analytics, and solutions to financial institutions, banks, insurance, and corporates. These solutions help clients identify, measure, and calibrate a comprehensive range of risks: credit risk, price and market risk, exchange and liquidity risk, operational risk, strategic and regulatory risk. We're so pleased to have the team from CRISIL presenting with us today, and we will have Manish Jaiswal and Amit Vora.
Okay. Good afternoon, good evening, and to almost all participants across the globe. I'm Manish Jaiswal. I lead the CRISIL Research and Risk Solutions practice. Welcome to the seminar on early warning signals. It's a pleasure to host you this seminar. The idea for today's seminar is largely to discuss the challenges which most of us encounter is during the portfolio management or the loan life cycle management, especially of small business customers. By small business customers, I specifically refer to customers who probably will have annual sales of less than 5 million, or in some geographies maybe going as much up to $10 million of annual sales. The most important issue which we face in this segment is very clearly that the lending is not based on financials. It is based on surrogates, estimations, and a lot of judgment on the field of the credit officer. So therefore, it is almost tantamount to saying that we are doing loans on basis on a whole lot of pragmatic assessments, which may be subjective, which may vary from banks to credit officers to another credit officer. While we do this, it is very important to realize that during the loan of a small business banking customer, we constantly are faced with a challenge on how do we monitor the loans. We believe that every loan during its life cycle emits certain health signals. Whether the health is weak or strong, are we able to capture those signals? Are there signals in the first place? How do we differentiate signal from the noise? How do we gather these signals towards meaningfulness? Are we in a position to act on these signals proactively? Well, this is what this seminar is going to be all about. Today what we are going to discuss is there a science in this madness? Is there a methodology on how you can gather signals, combine signals, look at critical signals versus non-critical signals? Can you do analytics on signals? Can you do a proactive assessment of loan 6 to 9 months or a year in advance before it turns bad? If you are in a position to do that, hopefully you would be able to not give more loan to a customer who is going to default. On the contrary, you may be wanting to cut the loan down and in fact seek more collateral, therefore improving your both probability of default as well as loss given default, and therefore the expected loss could be as much, the loss could be as much as down by 50%. And this is what we observe in good banks in India and geographies where good banks typically are running NPA of 1% or 0.5%, while the banks who are not so active are running it 3 to 4 times, maybe more than higher than that. So with this, I hand over the session to my colleague Amit Vora. He will take you through the concept pioneered by CRISIL Risk Solutions on early warning signals, and then tell you about expertise for we are implementing the solution in the largest private as well as public sector bank in India. Amit, over to you. Thank you.
So good day, everybody. Very pleased to be here today to take you through this session on early warning. We believe this is a very pertinent session in the current environment of lending across emerging markets, and more so for small business banking, like Manish mentioned, given the unique challenges that small businesses face. So without further ado, I will start with the first section, which is an introduction, where we will set the context for proactive credit monitoring. So if you look at some World Bank data, it's very, very clear that most of the emerging markets are struggling with mounting gross NPA levels. Be it the Indian subcontinent, Africa, or Asia, each of these nations are seeing gross NPA levels ranging from 4% to as high as 13%. So what we are saying is that emerging markets are struggling with mounting losses on their loan portfolio. A key reason for this is the reactive credit risk management practices. Today, in banks in the region, typically a lot of emphasis and focus is at the credit sanction or appraisal stage, and thereafter straight once an account is declared a non-performing asset or has gone into default. Invariably, there is no proactive monitoring happening across the loan life cycle. So we are largely living in an environment of reactive monitoring, where a bank or a lending entity realizes that an account has gone bad and then only focuses on how best to take corrective action on an NPA, rather than taking cognizance of certain signals of stress and minimizing stress much before it occurs. So what we are living in is an environment of alarming gross NPA levels and an environment of reactive credit risk management, which necessitates a structure for making it proactive. So this is the context in which we live in, and therefore it becomes very pertinent to look at this environment and try and understand what banks really are doing with respect to credit monitoring. So here we have a poll question, and I will request Jessica to take you through this question.
Great, thank you so much. And so we'd like to get a sense. We've got a very strong number of participants from a lot of different markets, and so we'd like to get a sense from you. What is your assessment of your bank's or financial institution's current credit monitoring practices? So, are you sufficient and ahead of current market practices? Sufficient but room for improvement? Insufficient? Significant room for improvement? Or insufficient? Total overhaul required. So we'd like to take about 30 more seconds here to answer this poll, and we're already getting some good responses, and this is a poll where you will choose one answer. So we'll wait another 20 seconds or so, and we're going to get a few more responses coming in here, and we'll just take another 10 seconds or so. And Amit will be able to give us some sense of where this fits into the conversation, and we'll take another 5 seconds here, and we can go ahead and close the poll. Great. So as you can see, it looks like most of the participants are doing some type of credit monitoring practices. It's sufficient, but there's some room for improvement, so 57%. Whereas the next ranking is insufficient, significant room for improvement at 35%. And both at 4%, we have a couple people that are at the very, very high end and very, very low end. So Amit, I will turn it back over to you.
Yes, thanks Jessica. So I think the results are very well aligned with what we've also experienced in the geographies that we operate in. So we've clearly seen that there are several banks who have some techniques and tools that they use for monitoring, but it's not a holistic system. It's not an approach which is comprehensive and that capitalizes on all the possible data that a bank may have on a particular borrower. So I think the results are very well aligned to what we would anticipate, and I think that puts the entire context for today's session very pertinent, and I'm sure the audience will truly benefit from what we will be covering today. So I'll get into the main concept of early warning signals. So what really are we talking about and what are these signals? So if we start with a very basic definition, the way a dictionary would define a signal, and I'm just going to focus on the key parameters that I've highlighted in bold, we are necessarily talking about a gesture or an action that conveys some form of information. So very clearly we're talking about a signal that gives me inputs that can help me decide. So that is a very basic definition of a signal, and that will help us identify the right kind of parameters that define a signal. So it needs to be a gesture or an action that gives me some form of information. Now coming to early warning, obviously a signal is useful only if it gives me some sign of stress or difficulty well in advance. So an early warning signal essentially helps me identify vulnerability in an account far earlier than what it could be and far before it turns delinquent. Only then we will be able to take corrective action to safeguard our capital. So it's not important just to identify a signal, but the signal needs to give me an indication much before an event of stress is likely to happen. So that's clearly what an early warning signal for us would mean. So when I look at different types of early warning signals, I need to keep in mind that I need a comprehensive view on the portfolio or on a specific account. So when I'm looking at early warning signals, they need to look at various aspects and dynamics related to an account. These could be, and we are looking at certain examples here, they could be related to the account conduct or the transactions that my borrower is going through. It could be related to compliance. So there could be certain angles on compliance, and I need to keep monitoring my borrower whether he is completely in line with what I would ideally want in terms of compliance. The third and very obvious is financials. So how is my borrower performing on certain key financials? And the fourth and very important, especially in the context of a small business, is the customer pulse. And this is something we will focus on as we move through the presentation. How exactly is my borrower behaving on the ground, where data may or may not be readily available? So this is the pulse I have as a lender on my borrower, and that becomes a very, very critical input when I want a comprehensive and holistic view on the health of my borrower. So to summarize, these are the four categories that we will take you through during our discussions today. These signals become the most important component of the credit monitoring process, and they actually give you a direction on whether a particular account is likely to go bad. So the most important step would be to identify specific signals that give you this sense of direction across these categories. So let me take you through some examples of such signals. So if I look at the first one, which is on account conduct, which we necessarily refer to as the transactions that your borrower has with your bank. So what happens is that typically your borrower may not be defaulting on the loan, but there are several other transactions that he's undertaking through your own bank that will give you rich information on how he's performing. For example, you could be giving him working capital limits where he's reducing his drawing power. There could be some of his checks which are bouncing or being returned inadequate. He could be issuing bank guarantees or letters of credit which are getting devolved or invoked. There could be limits which are being utilized to their absolute maximum. For instance, there could be credit summation that is not matching the sales that they are reporting. So there are various signals that can give you a sign of what's really happening on the ground with respect to your borrower. As a good banker, typically this would be something that you anyway monitor when you are looking at the performance of your borrower. So we are saying that these are the most critical signals that will give you information on the performance of the borrower, independent of how he is performing on your loan. So he could be paying your interest on time, he could be servicing the principal payments on time, but there are these other stress factors that give us rich information on where he is really going with his transactions. The second category is compliance. Now this is an often neglected category of signals. So while we will all have operations or credit administration teams that monitor compliance levels, invariably they are not inputs that go at the time of monitoring an account. So we believe these are very important signals that one needs to monitor periodically. These could be in the nature of security creation, in terms of documentation that could be incomplete. It could be in terms of submissions that he needs to periodically make as a borrower, which could be incomplete. So how do I build all this into my monitoring practice so that as and when I need to really take corrective action, I'm ensured that at least on compliance, my borrower is completely up to speed and I'm not missing out on certain key requirements that will help me take corrective action. So compliance is a very critical aspect in this entire trigger library. The third and the more obvious one is the set of financials. So how exactly is your borrower performing on certain key financial metrics? Now here again there is an interesting fact that typically you will always have information about your borrower and your relationship manager will invariably believe that your borrower is performing very well. However, it's important to have a reality check and really compare your borrower against benchmarks and peers in the industry. It's only then that you will have a reality check on whether he is performing well or he's underperforming the industry at large. So while, for example, you may believe that your borrower's EBITDA margin at 14% is very optimal, actually you may know that in that industry 18% is the norm and anything below 15% is clearly not acceptable. So this benchmark becomes very important for you to understand and appreciate the performance of your borrower. So we believe that in financials, the certain aspects of financial performance that one needs to look at are, of course, profitability, overall capitalization, coverage, liquidity, and asset efficiency. Of course, as I mentioned, this has to ideally be against benchmarks, peers, and estimates of the industry at large. Only then would it be really meaningful and give us a complete picture. The fourth and very important segment of signals that we need to look at is the customer pulse. Now this becomes all the more important in small businesses or SMEs where financial data or transactions may be minimal. So you are relying on surrogates like Manish mentioned sometime back while giving a loan, but you also need to rely on ground level information and inputs when you're monitoring the loan. And that necessarily comes through what we call the customer pulse signals. How does a bank really get this information? You always have your relationship manager going on site, interacting with the borrower. He will have access to a rich set of information points which he needs to put into your monitoring framework to give you information. Very simply, this could be signals such as an inaccessible or non-cooperative borrower. We are often faced with this practical reality that when your relationship manager is seeking a meeting with the borrower, he is ignored and a meeting is avoided for weeks together. This is a clear sign that there's something that could be wrong on the ground. Another input could be diversion of funds. So let's say your relationship manager gets to know through his contacts in the market that the borrower is known to divert funds for projects not as a part of this company. That's an important input that you need to know. You could also have other signals, for example, disputes between the promoters, labor unrest on site, mounting inventory. So a large number of signals that give you a sense of actual performance on the ground, which need not be transactional or financial in nature. So very important, and we believe the customer pulse signals in the context of small business banking become very important. Now coming to what really makes you understand whether a signal has been breached. So a signal is only as good as the benchmarks and thresholds that you set for them. For example, when we go to a doctor and get our temperature checked, we all know that 98.6 is normal. Now that range of normalcy has been established and proven by experts, and that's why it becomes very easy for us to measure temperature. So similarly, for all the set of signals that we talked about, what are those ranges of normalcy that you will define for your borrower set? That becomes very important because you will measure your borrower against those parameters and ranges of normalcy. Again, the interesting thing is that these ranges will differ depending on the segment you are talking about. It could also differ depending on the industry. So there are industries where some triggers may have different benchmarks. So what we've given on this slide are an illustrative list of benchmarks for high risk and low risk. Obviously these would fine tune depending on the geography, depending on which segment of the industry you're looking at. also, for instance, which segment of borrowers you're looking at. So what we've given you and is an illustration. For example, a 15-day delay in interest servicing could be considered high risk. Anything below 15 days is low risk. So very clearly we need to establish these thresholds for each of the signals that we identify as relevant and pertinent for effective monitoring. What we are taking you through now is an example of a bank that actually went through this process and ran this library of signals on 2 of their companies to really identify which companies breached the signals and therefore which were identified as potential defaulters. So this is more like a brief case study we are taking you through, where a specific bank ran their portfolio of companies through the signals that we've identified and were able to really pinpoint which companies were likely to default. So on this slide, we've actually shown you 2 companies, company 1 and company 2. And for each of the triggers, we are telling you what the actual measure that company achieved. For example, company 1 has been delaying interest servicing for the past 12 days, whereas company 2 has actually been paying on time. Similarly, we have different triggers being breached, and for each of them, based on the thresholds that we've established, it becomes fairly straightforward and simple for us to identify which of the companies is breaching how many triggers, and therefore which of these 2 companies is actually expected to default based on the prediction model that I have developed. So in this case, company 1 is breaching 8 triggers out of 20, which is over 40% of the triggers. And based on the internal model this bank had developed, we believe that this company is expected to default because it's showing signs of stress in these 8 triggers. So the triggers this company has breached are drawing power reduction, a quarter-on-quarter decline in credit debit summation, inward check returns being above the threshold, a high degree of limit utilization. We also find a key compliance trigger that has been breached where we see that the security is underinsured. In financials, we are seeing that actual sales are not matching the estimates, and that's a huge deviation of 40%. We are seeing mounting debtors which have crossed the 90-day threshold and presently are at 98 days. And finally, an on-the-ground signal, which is a very, very useful input, is delay in payment of salaries to staff. So very clearly a sign that yes, something is going wrong. The company is not able to pay its staff its salaries each month, is one more input that gives me a sense that this company is going bad. So in this case study, 8 signals were breached, and therefore company 1 was identified as a potential defaulter. Now, what you saw was a library of signals that this bank had identified. Now, how did they really go about identifying signals? You can actually, as a good banker, probably as we speak itself, think of 40 other signals that could be relevant. But how do you fine-tune and identify a library of manageable signals for which you are getting enough data for you to be able to monitor effectively? So there are certain key techniques that we use typically to identify effective early warning signals. So the 2 things that we look at typically are, 1, the relevance or strike rate. So the question here that we are asking for each signal is, does the selected signal occur for the type of borrowers that we are trying to identify? So what is the relevance of the signal? So if I'm looking at a certain category of borrowers, is that signal really relevant? Am I going to get the right kind of information about the borrower with respect to this signal for me to be able to judge whether he is likely to default? For example, we are looking at number of defaulters that exhibit frequent check returns. So here, if I want this to be an early warning signal, I need to have usage of checks as a prominent feature of that borrower set. Now in India, we often have small businesses which may not be using checks very effectively for payments. So this could be a non-relevant signal in that context. So it becomes very important for me to know whether the signal is really relevant for the segment I'm looking at. And for me, it's desirable to look at signals which have a higher strike rate. So where I know that a large part of the borrower segment will be depicting what the signal is showing. So that's an important point. The second and very important is the discriminating power. So how much more often is the signal likely to occur for a type of borrower that I want to compare with the rest. So very clearly, as an example, if we are talking about 20% of defaulters exhibiting frequent check returns compared to 10% of non-defaulters, I'm looking at a discriminating power of 2. So this is a fairly high discriminating power, and it tells me that this signal will be effective for me to judge across low or moderate high risk customers. So my desirable signal here would be one which has a high or low discriminating power that is largely away from 1. So either it could be a low fraction or it could be a high number, so that I'm able to effectively discriminate across borrowers based on the strength of the signal. So these are two very powerful measures of deciding whether a signal is pertinent for your borrower segment. Now, do the signals that we identify using this approach remain constant? The answer is definitely no. There is a logical process that is involved in calibrating the early warning signals with time. So the signals need to evolve over a period. There is a logical process, and this process is very similar to a typical process in any model development, even when we use at the time of onboarding of a customer. So typically you have an expert judgment model that you use in the initial period. This is the period where you don't necessarily have relevant data available. So you need to decide based on your expert judgment as a bank, what are the select signals that are pertinent, what are the triggers that I need to define and the thresholds I need to establish, and the criticality for each signal. So how critical is each signal in my entire model? So at this stage, we are purely at an expert judgment stage. We are relying on our collective judgment as banking experts to decide the model that will best suit me and the set of triggers that I need to put in my library for my target. As we start using the model that has been defined, as a bank or a lending entity, I will start collecting data on the triggers that I've been using. So let's say over a 12-month period you've been using the trigger library. You will be left with a rich source of data which will help us do backtesting. So my next stage is backtesting of the triggers, where I will actually use your actual data as a bank to see how these triggers have behaved in predicting signs of stress. So if I am seeing that a particular trigger is giving me a good sign and discriminating power, that will help me fine-tune my overall model. So I'll be able to fine-tune not only the triggers that I select, but as the weights as well as the overall threshold limits and scale for early warning detection. So that is an important phase of backtesting. Finally, in over a 2 to 5 year period, as I have even more data, I can actually move towards statistically significant signals. I can go towards weights being driven by coefficients rather than just expert judgment. And I can also look at eliminating triggers that generate noise. So it's not necessary that all the triggers we believe intuitively to give us a sense of stress or direction on stress will always give me that discriminating power. There could be certain triggers that generate noise. There could be certain triggers that have a collinearity, and those need to be eliminated, which I can do if I have enough data. So my model needs to evolve over this 2 to 5 year period from being an expert judgment model to being a data-driven model backed by statistically significant signals. So this is how the overall early warning process will calibrate with time. We are now ready for the next poll question. Over to Jessica.
Great. Thank you so much. And so we'd like to get a sense if your bank, your financial institution is already using one of these models, we'd like to know what type. So are you using a statistical model developed using your own data or multiple years data? Yes, a hybrid model combining statistical models and scorecards, or no, expert judgment-based scorecards models, or no models used, or let us know if you're not sure what your institution is doing. So we'll take a few more seconds here, and it looks like we're getting a good response sort of throughout the different answers here on the questions, but we'll go ahead and take about 20 more seconds here for this poll, so about 10 more seconds. Great, and so we'd like to hear from just a few more folks, and we can go ahead and close the poll at this point in time. And it looks like the majority of the institutions who are joining are not using any model at this point in time. So 30% are not using any type of risk model. And about 27% are using the expert judgment-based scorecard or model, and about 24% are using a hybrid model. And we have about 9% both saying they don't know if they're using a model, and 9% using a statistical model based on data. So Amit, we'll turn this back over to you.
Great. Thanks, Jessica. So again, I think the results are quite in line with what we would have expected and anticipated. So while we believe that a number of entities do have some approach to monitoring, they are largely expert judgment based triggers or scorecards that are used. And invariably we've seen that statistical techniques are not so far being adopted, especially by the larger banking community that focuses on even small businesses, and that's largely due to absence of data and an effective system which combines the power of all data sets coming together. So I think this is also in line with what we would have expected. So given that what we just saw in the poll, it becomes very important to see how do we have a logical and system-based approach towards monitoring. Very clearly, if we have to rely on statistically significant data sets and develop a model that moves beyond expert judgment, I need to rely on the power of a system to bring all this intelligence together and help me monitor my portfolio in a risk-intelligent way. How do we do that? And that's what we will cover in this third session of the webinar today, which is a system-based approach towards monitoring. So when we look at a proactive monitoring system, which is the need of the hour like we saw in terms of the context, there are key aspects that need to be covered in a system. One, it needs to help me identify the right accounts that are showing signs of stress. So my system needs to have the potential to flag stressed accounts well in advance using the library of early warning signals. Two, it needs to inform the relevant management within the bank of the sign of stress. So very clearly there needs to be an effective workflow system that not only identifies the signs of stress, it actually provides actionable intelligence. So there has to be an action associated with that intelligence on the basis of which somebody in the bank is able to take corrective action. So there is an automated input that needs to flow from the bank's data. We cannot rely on a manual mode. That data needs to flow in an automated way and inform all relevant stakeholders about what's really going wrong. And that information has to be based on not only internal information that the bank has, but also on external data feeds that could be relevant. So the second pillar is information, and the third is very clearly resolution. So I need a system that helps me plan the resolution strategy with respect to a borrower. So what is the corrective action I need to take at an account level? Who in my team needs to take that action? At what periodicity do I need to monitor the action and establish internal triggers and mechanisms to ensure that the corrective action happens as planned? So very clearly a proactive asset monitoring system needs to address these three key pillars of identification, information, and resolution. Now coming to the slide on the overall approach of going live with an effective early warning system. So the first and foremost step here would be to develop an effective trigger library. So what we saw in the previous sections, we talked about triggers, categories of triggers that we need to see, which is on customer pulse, on transactions, on financials, on compliance behavior. We also saw that each trigger needs to have a certain threshold that needs to establish the ranges of normalcy. We also talk about every trigger being assessed for its overall discriminating power and relevance, based on which we would assign a criticality. We also talked about benchmarks. So very clearly the trigger library is the heart and soul of an early warning system. Enough time needs to be spent on developing the right trigger library for your set of accounts. Now, again, the trigger library has to be specific for different segments in your bank or lending entity. For example, the trigger library for small business loans would be very different with respect to the trigger library for, let's say, a large business, or for that matter, an infrastructure loan. So different business segments will have different trigger libraries. Each of the steps involved in developing a trigger library is one, identifying the source of input. So where will we get the information for that trigger to work? I need to be very clear and I understand where that information will come from. Is it going to be from an internal system of the bank? So every bank has a core banking system. It has a treasury system. It has a transaction system. Will I get the information from there? Or am I going to get information from external feeds? For example, it could be a credit bureau feed. It could be feeds from a rating agency. They could be feeds from a third-party research provider. Where will I get the data? I need to be clear on that. Second is the frequency of monitoring. Every trigger in my library will have different frequencies of monitoring. For example, financials for a particular company I may get at best every quarter, or in some cases every year. So those triggers related to financials would be quarterly triggers or yearly triggers. But transaction triggers, for example, checks that are bouncing or checks that are being returned, I can actually look at on a daily basis, or I should effectively look at on every end of day how many checks are bounced for a particular borrower. So the frequency of monitoring for each trigger will be different and will be established by the recency of data that is available and how frequently it's possible and practical to monitor that particular trigger. The third is criticality. So how critical is a particular trigger in my overall scheme of things? There could be certain triggers that will straight identify a borrower as a potential defaulter irrespective of movement on other triggers. These could be certain high critical triggers. For example, it could be checks bouncing beyond a particular threshold that I believe are very clearly signs of stress, and I need to straight take this category of borrower into high risk. So I would need to assign criticality for each trigger. The fourth are the benchmarks or thresholds. Again, these to begin with, as we mentioned, would be on expert judgment, and with time would be moderated or fine-tuned based on my experience as a bank. And finally, the weights. So what we are talking about is a trigger library or model that will assign weights to each trigger. Some triggers will be more important than the others in my overall scheme of assessment, and I will need to assign weights. So to summarize, the development of the trigger library is the most critical and important step in this early warning system. The second would be to define the scoring mechanism. How do these triggers come together in a singular score for a borrower that helps me judge whether he is low, medium, or high risk? So that is my scoring mechanism that I would define. In parallel, I will also need to develop the overall internal process and standard operating practice or SOP with respect to this overall monitoring process. So who has to take what action at what stage? At what stage is an assessment undertaken for a particular borrower? Are all the triggers assessed at a given point in time, or do I need to do a two-stage assessment where you have a preliminary assessment and a detailed assessment? So there are various options with respect to the process that one needs to undertake. We also have an important aspect of a gap analysis where we compare the data that I have vis-a-vis the systems available within the bank, and this will help me understand the implementation and integration requirements when I'm automating the system. So the idea and objective is to automate as many triggers as possible, for which I need to rely on source systems within the bank, and therefore on the basis of the source systems and triggers identified, I will develop an integration mechanism which will ultimately feed into my system and help me generate early warning signals. So with that process, I'm able to implement an effective early warning signal system, which I then train my staff and actually build a culture of monitoring proactively rather than reactively. So one of the most powerful collateral benefits of putting in place an early warning system is the credit culture that gets developed within a team. The kind of triggers that a bank will monitor will actually feed into the overall credit assessment process itself. a lot of on-the-ground triggers which give me a sense of customer pulse. My relationship managers would then become proactive in identifying even at the appraisal stage. So what we believe is that an early warning system effectively developed and implemented in a bank actually completely changes the credit culture within the bank, and this is one of the key benefits that a bank in the medium to long term would have if it puts in place an effective early warning system. With that, we have the third poll question.
Amit, we actually have a question. If we could go back to the previous slide before we go into the poll. We had a couple questions in terms of how setting up an early warning signal system works with a core banking system. So, is this practical to set this up? How does a bank set this up, considering that each bank has its own core banking system? So that's one part of the question. And then how does setting up something like this affect the NPL rate? Do we actually see the NPL rate lowered if we set up early warning signals?
Okay. So to answer your first question, which is on how practical it is to effectively implement an early warning system, given that each bank has a very different core banking system. So if we look at the implementation of an early warning system from a technology perspective, yes, very clearly each bank has different processes and approaches to capturing data. They have various internal systems, and it's not only the core banking system. Each bank has their own internal treasury system. They will have an internal rating system. They will have an internal core banking system, and all these could provide wealth of information for me to proactively and effectively run an early warning system. So when we look at the approach of developing and implementing an early warning system for a bank, the interfacing with the core banking is a very important and critical aspect, where we actually define the formula for each of our triggers. We then identify specific data sets that are available in the core banking and internal systems and map that so that we are able to effectively extract relevant data. So it's a very practical question, but it's a part of the implementation process where the technology teams from the implementation as well as the bank teams will sit together and identify specific data sets that are available within the bank's core banking and perform an extraction transformation logic for extracting the right type of data that is relevant for my signals. So that's a very important step in the overall process, which is what we've identified as developing an integration mechanism. So how do I integrate the different sets of data so that I get the right kinds of signals? And if a bank has a good, effective data warehouse, it becomes all the more easier, but it's also possible to directly interface with the core banking and extract data in line with the formula and triggers that I need. To answer your second question on whether NPL rates actually come down with an effective early warning system, the answer is a categorical yes. So we have several banks, and in our experience, some of the good, well-performing banks in India itself who have been using their own internal early warning systems. If we see their gross NPL rates, they have been consistently single digit or below 1%. They are far lower than the average in India, which is 4%. So we have seen this with a large number of banks in India where they have a proactive and effective internal early warning system, and they are able to effectively manage their gross NPL levels well under 1%. So that is clearly a benefit that we see of early warning systems.
That's very, very helpful. We're starting to see some more questions in, so I think we can continue to move forward, and we'll go ahead and take the rest of the questions during the discussion period.
Great. So then we can run one more poll. Over to you, Jessica.
Great. So as we're discussing this, we'd like to find out if your bank or financial institution has employed a structured approach to early warning of potential defaulters, and what type. So go ahead and choose one of these. Is your financial institution using a structured process implemented with a product or software solution, a structured process but no product or software solution, or an unstructured reactive monitoring on an ad hoc basis, or no early warning process at all? So we'll go ahead and take about 1 minute here, and we're already starting to see quite a lot of responses. So we'll go ahead and wait another 15 seconds or so on this and take a few more responses, and we can go ahead and take about 5 more seconds here. So if you haven't responded, we'd like to hear from you, and you can go ahead and choose one. And let's see if we have any other responses. Okay, we can go ahead and close the poll at this point in time. So we're seeing that most institutions are either doing an ad hoc, unstructured reactive monitoring, or a structured process but not using any type of product or software solution at 35 and 31%. And then about 19% of the financial institutions are using a structured process with a product or software solution. And some of the institutions have no early warning process. So, you know, for the institutions that are doing this, the structured process, you know, we'd love to hear from you and how this is working for you during the discussion period. So if you have a comment to make about, you know, how this has affected your institution or your NPLs, as this seems to be a very important question, please feel free to, you know, raise your hand or put a comment in there, and I can unmute you during the discussion period to continue the discussion. And Amit, I will turn it back over to you.
Great. So thanks, Jessica. Once again, I think what we are clearly seeing is an overwhelming 80% who either have a structured process but no software, or they are using an unstructured ad hoc process, and in many cases they don't even have an early warning process. So again, this is in line with what we would have expected given the specific markets that we are talking about, where an effective early warning or proactive monitoring is not really seen the light of day. So this is clearly in line with our expectations. So with that, I move to my next slide, which actually summarizes what a robust and scalable early warning system looks like. So what you see before looks like a fairly complex image, but in reality it actually very lucidly explains what an effective early warning system should really be doing and how it really would function. So what we have on the left is the bank's portfolio, and that entire portfolio would be put through a filtering mechanism, which is our early warning system. So our early warning system is actually split into two parts. We have a preliminary assessment and we have a detailed assessment. This is very similar, if I have to draw an analogy, to our own health. When we fall ill and have fever, we would first go to a doctor and go for a routine checkup. The first set of checks that the doctor conducts, it could be a temperature check, it could be checking you for blood pressure. Certain very basic tests that he does would be your preliminary assessment, and thereafter, based on the result of the preliminary assessment, if the doctor feels that there is a reason to take up more rigorous tests, could be a stress test, it could be an ECG, it could be a PET scan, these would come in as a detailed assessment. So we are literally putting the bank's portfolio to a similar rigorous assessment process where you have a first level of preliminary assessment and a second degree of detailed assessment. So what exactly would a preliminary assessment have? We are saying that the first set of signals I would need for my account are very clearly how the account is behaving on a regular basis in terms of transactions. So are his checks bouncing? Are BGs getting revolved? Are any other signals with respect to transactions getting breached, which I need to monitor, and I can monitor routinely because I have a core banking system that can give me this data. Similarly, are there any external feeds with respect to the borrower that I need to be mindful of? For example, there could be a rating downgrade by a rating agency. It's an external feed but very important, and I would like to know about it on a real-time basis. Similarly, there could be a credit bureau score for the promoters. So if the promoter has taken a personal loan and defaulted, I would like to know about it, and it could be an important alert for me in the initial stage itself that this is an incipient sign of stress. Similarly, there could be various other signals I may prioritize and keep as a part of my preliminary assessment. It could be related to compliance as well. So some fundamental signals which I believe are important for me to judge whether my account should be classified as a low risk, moderate risk, high risk, or a very high risk. So based on that preliminary assessment, my filtering mechanism gives me various categories. I then put it through an internal screening, and based on which, depending on whether I want to do a detailed assessment or not, I will put it through a detailed assessment where we have a different set of more rigorous signals that I will perform on my borrower. These could be benchmarks, like we mentioned, a reality check on the borrower. How is he performing vis-a-vis peers? It could be the customer pulse, where I roll out an on-ground assessment by my field officers, let them go and interact with the borrower, understand what's happening on ground, and send me a report. It could be also analysis of stock and book debt statements, which he gives me periodically. How is he performing there? Are debtors mounting? Is inventory piling up? Etc. So that would be a detailed assessment that my early warning system gives me, based on which I can decide what corrective action I need to take. Corrective action could be restructuring the account, ensuring a recovery, or some form of rectification with respect to the borrower. So very clearly, an effective early warning system has to run this entire path, right from a preliminary assessment to a detailed assessment, to enable a bank or a lending entity to take corrective action and manage the overall portfolio very effectively. So in our view, this is clearly how a good, robust early warning system needs to look. So with that, just to summarize, we have actually covered the entire science of early warning. We've started by setting the context as to why in the emerging markets, early warning systems become very relevant. We've seen the mounting gross NPA levels across emerging markets. Thereafter, we've talked about what signals are and what early warning signals are, how these signals look, what facets of a borrower they need to cover, right from transactions to compliance, how he's performing financially, and finally what's really happening on the ground. So various segments of customer pulse that give me a very strong idea about performance. We've then talked about thresholds that need to be established for signals. We've talked about discriminating power and criticality that needs to be assessed before deciding what signals need to be there. And finally, we've talked about the overall process of defining the trigger library. And finally, we've also talked about an effective early warning system and what it really looks like for a bank. So what it needs to do in terms of preliminary assessment and detailed assessment for you to give a very strong idea on performance. So with that, we've actually captured the overall flow. This is exactly the approach we as risk advisors use in large banks in India and abroad while helping them put in place effective early warning systems. With this, we will now open to questions. I believe we already have some questions that have come on the webinar itself, and we will be ready to take you through our responses on each of these.
Great, excellent. Amit, thank you so much. And I'm going to unmute one of our partners in Bangladesh. Hassan, can you hear us okay?
Yeah, I'm hearing.
Great. Hassan, we have you unmute for the session, and so feel free to ask your questions directly to Amit and the CRISIL team, and feel free to share where you're from if you'd like as well.
Hi, Amit, good afternoon. This is Moinul Hassan from Bangladesh, and my institution is IDLC Finance Limited. I have a question. Is the early warning signal a pre or post financing mechanism? Number one. And number two is, if it is a post facto post financing mechanism, then how the early warning signal help us to collect our overdues or to settle the loan? Hello?
Great, thanks. And thank you so much for this question. So to answer your first question, is it for pre or post financing? So very clearly the early warning system is intended to make the overall monitoring very effective. So it is a post financing system. Having said that, what we firmly believe that the way an effective early warning system is implemented, it also actually benefits in the pre-financing stage by developing a very rich and strong credit culture within the bank. So it's more a collateral benefit at the pre-financing stage, but the core intent of the system is at the post-financing stage when it actually helps you monitor after you have given a loan to a particular borrower. So it's actually helping you proactively monitor performance of a borrower after you have given a loan so that you are more assured about timely collection and timely repayment of dues. So that's your answer to the first question. Coming to the second question, how does it really help in collection? Well, the purpose of the early warning system is to actually alert you as a bank much before an account is likely to go bad. So the idea is that before an account turns a non-performing loan, there are certain signals out there which can alert you as a banker that there are signs of stress. As a banker, if I'm able to observe and identify them early, there is corrective action I can take much before it goes bad. That corrective action could be downselling the loan. It could be seeking further security so that my position as a lender is more secure. There are various corrective actions I can take to strengthen my position as a lender so that when it comes to collection and ultimate recovery, I'm in a better position to ensure there is no non-performing asset. So yes, it helps in effective collection to that extent where it helps you identify stress much before it happens. Does it help in direct collection? No, it's a system that actually helps you prevent sign of stress before it happens, identify that stress and take corrective action. So that's the objective and purpose of the system.
Okay, yeah, so basically it may help us it gives a signal and may be helpful for the bigger customers, but for the smaller customers are very, for the micro and small enterprises, the early warning signal doesn't help us a lot, because the moment we can understand the client is going to be bad, in that moment he has lost everything and he is already in big trouble. So digging him out from the ditch sometimes doesn't become possible.
I'm Manish Jaiswal here, if I can take this question, Anil. Actually speaking, early warning works best for clients where the financials are very weak. Typically speaking, in Bangladesh, for such small clients, you would be doing financing basis local field intelligence. When you meet customers on the ground, you make assessments, you do checks of buyers, suppliers, you understand the local margins, because financials don't speak much, don't you?
Yeah, yeah, right.
So presume you do that.
Basically, the credit scoring model.
So you use
credit scoring model can help us a lot.
Correct. So you use some form of model, but what happens is that there is no model which works once you have done disbursement. The credit scoring model was good at the point of time when you are doing assessment for loan. After you have done loan assessment, you are not doing any other client assessment during the loan life cycle. So therefore, it is exactly dealing with the signals. So there are various forms of signal that Amit mentioned to you. One, signals are coming from the way the customer is showing behavior in the account. For example, if you believe that the customer has promised you next year he will grow on top line by 20% and similarly on the bottom line, so therefore the accounts have to show that much of sales happening in whatever form. Or if you are seeing signals on the ground through non-transaction signals, which means that your collection people, the credit officer, the relationship manager are going to meet on the field and they find some adverse news. They found that a tax raid has happened, or the shop remains closed, or the buyer is not available. So to that extent you are getting field signals. So the system actually is a tool which pushes you to capture on-ground, off-ground, financial, non-financial signals so that you pick each one of them and make a judgment. So actually speaking, it is very and more relevant for small businesses, and therefore we believe we have taken this topic for an SBBN session.
Great. Thank you so much, Hassan. We actually have a few other questions. So we're going to move over to one of our partners in East Africa. Patrick, can you hear us okay?
Yeah, can you hear me?
You're a little soft, so if you want to speak up. So Patrick, feel free to share which institution you're from, if you like, and ask your question directly to our presenters.
Okay, my name is Patrick Lumumba. I work with African Guarantee Fund. We work with commercial banks. We provide guarantees to commercial banks so that they can access finance to SMEs. I had two questions. One is a lot of these depend on readily accessible, constant and reliable flow of data for risk levels to be gauged. So how does a financial institution ensure that it has accessible, constant, reliable flow of data regarding the performance of their SME customers? Then the second question relates to how do financial institutions cost effectively monitor diversion of funds by the SME customers? Banks are relatively sensitive with regards to the costs involved in monitoring of some of these activities, and they usually sit pretty comfortable after disbursement of funds and wait for repayment. So how do they cost effectively monitor diversion of funds? Thank you.
Thanks, Patrick. This is Manish Jaiswal here again. Very good questions. My compliments to you on raising very relevant and pertinent questions. The fact of the matter is, whether are you in Africa or India or any other part, banks do not have dearth of systems, be it a Temenos or be it a Flex or a Finacle. Most core banking systems or trade systems are existing in the bank. Obviously, you cannot bank without, if you don't have these basic systems in place, be the treasury systems. So let's focus on this purpose for small business banking loans, for which the most important part is the trade, the loans, the letter of credit, bank guarantee, the loan system, and a core banking system, which I presume these four are going to be most vital. Most banks obviously can't bank without them. The fact of the matter is that how many banks actually capture the relevant data sets properly? Now, it's a journey. You will figure out that most banks suffer from the malaise called the data need to be purged. So the data is not pure, data is unclean. You have to restore to data cleansification. You have to run validational tools and techniques. And over time, you have to perfect the model. Because if you don't perfect the model, how will you ever reach towards Basel III? So anyway, it is becoming an imperative, and banks are moving in that journey. So to that extent, the systems exist, the habits need to change. And when you implement a system like this, slowly and slowly the culture of getting the key elements of data begins to percolate and permeate down the line, and it improves. So first you work on significant and important triggers, then you work on other triggers, then you go to your operation shops, and then you tell them for every check bounce, please put the reason, for every transaction done, please put the reason. So then you start building the data slowly by slowly, and then build the culture. So from day one, the data flow is not perfect. From day one, what can happen is you can strive towards perfection. You can say, guys, I am not going to compromise in these top 15 triggers. If you don't do this, we therefore will do. You put a carrot and stick around that, and you make it, and you enforce discipline. There is no way you can do away with waywardness and slackness. You have to make things tight, and you change the culture. So it has got to do more with cultural shift, more about implementation, and we see that when you start driving the agenda, it does take, you start with an expert judgment model, and then you build data sets, then you move towards a hybrid model, then I will explain to you, you move towards a scoring based model. So it's a journey. You have to begin the journey. Either you begin the journey now or you begin it later is an option which bank chooses. So that's part one of your question. The part two of your question is that how do I effectively monitor diversion of funds by SMEs? Very, very clearly, why does a customer divert funds? Very largely, either he has gone greedy and he has changed the fund from a short-term purpose to a long-term purpose, and that long-term purpose could be in line with business or could be in line with other opportunities. So very clearly, whenever you feel, and liquidity in SME is like salt, if you administer more liquidity, you will feel diversion happens, and if you administer less, the client turns anemic. So therefore, the diversion monitoring can happen in many ways. If the loan is not commensurate to growth in sales or revenue, you may actually see that the credit debit summation ratios and the loan ratios, if they are not looking healthy, your account is prone to diversion. Secondly, if a diversion of fund has happened and the loan has begun to fall, you probably have caught it early. So therefore, while the cash flow is running in the system and you jam the system, you freeze the account, the client will be pushed to getting some money back. Otherwise, if the all money has run off and you're expecting the client to come back and repay, it may be too late by that time. So diversion could be measured at the very moment when a large check is cut, for example, today itself, and it is an unusual pattern, you probably have detected it. Normally, if a client if the credit debit summation says net is $100,000, it's looked like negative $100,000, you got the first alert. So when the money has gone out, within the next 48 hours, if you reach the client, you possibly have some hope of getting money back. Other ways of administrating, of looking at fund diversion, looking at other patterns. If fund is diverted, then you see slowdown in top line, slowdown in profitability, some check bouncing syndromes. So you will catch it early if you have a system where you're able to get a single view of the customer at one place. If your systems don't talk to each other, obviously it is a noise. So the message here is that how do you get systems to talk to each other, and you see a symphony than a cacophony. So,
Okay.
so that essentially is the model on which early warning system is made. I hope that answers your question.
Yeah, it's been helpful.
Great. Thank you so much, Patrick. We're going to take one final question from Arun Murthy. I'll unmute you in a moment. And if you have other questions, please feel free to send them over to us. We can connect you with CRISIL. And we'll also be posting another question on our LinkedIn group to continue the conversation, so you can get in touch with our team or the CRISIL team there as well. So, Arun, can you hear us? Arun, are you there? Okay, so it looks like his microphone is down. So I'll go ahead and ask that question directly to the team, unless Arun, you're able to jump on now. But I'm pulling up that question, so just give me a quick moment here. Okay, and so, in terms of using these early warning signals in these systems, if a loan does come up that it has some issues, and it may register high as an early warning that it would default, what are some corrective actions that you suggest other than restructuring that loan? So maybe you can talk us through some of those.
Well, Manish here. Jessica, just to answer this question on behalf of Mr. Murthy, Arun Murthy, I think we need to apply a whole lot of pragmatism in our approach. Any customer which comes to early warning framework, is he a bad customer? Answer to that is obviously not yes. If on a given day some of us are feeling sneezy, cold, and we have a bad throat, it does not mean that our health is bad. We probably need to do certain temporary corrections. So like this in business as well, there are cash flow mismatches. There are situations where there is a temporary delay. So the whole point here is that the practitioner, the credit practitioner on ground, he needs to make a judgment whether this problem is short-term or a long-term. If it's a short-term cash flow mismatch, obviously at the time, bankers have to come around and help the client and help him overcome the problem. Most time these are temporary cash flow situations which more often than not are administered through the additional liquidity needs, and therefore you are able to help the client tide over the temporary problems. So these are typically very prevalent in banking system. Some banks in India believe in giving temporary overdraft lines. Some believe in doing additional end-use based funding. Some do an escrow based funding and discount the typical receivables. So if it's a short-term problem, obviously you're dealing with it in a manner where you tide away the short-term crisis. However, if you've got to do with generic issues where the project is getting stretched by a long time, or for some reason the big buyer or a supplier has gone missing, and or there is a management dispute, or a third generation entrepreneur has come into the business, is trying his own new tricks. So some of these, if these are some of these long-term issues, then obviously that's the time when you have to really reassess, and you believe that it cannot be corrected at all, or it can be corrected under strong supervision or under tight guide rails. So then you look at a restructure methodology and you follow restructure. If you believe that it is imminent to exit before the account turns delinquent, then the third case could be an early exit, and the fourth obviously is inevitable, which means that there's but no option, that things are going to fade out, so then you only worry about cutting your losses. So I think these are the four techniques which most successful banks who maintain their portfolios well, they deploy. It's all about on-ground pragmatism, catching all the signals early, and choosing that when you reach the crossroads, have you turned towards the right junction, or if you are delayed, then probably you're headed for the last junction. So that in a nutshell is the answer to the question.
Great. Thank you so much. And Murthy, it looks like we've unmuted you. Did you have a response to that?
I just want to have just a network issue. Anyways, so the early warning signals. I work for Janlakshmi Financial Services, which is an NBFC MFI. Okay, so we offer structured loans to small and medium enterprises. Right. So the early warning signals, how do you pick up when you have a structured loan like us? Hello? Hello?
I'm really sorry, you're not audible. If you can please repeat your question.
Yeah, see, we are an NBFC MFI, and we fund structured loans for the micro and small enterprises. Okay, so in these situations, once the loan is dispersed, I mean, where is the chance of picking up the early warning signals other than they dishonoring the EMI?
So probably you are not a banking customer, so you are not privy to the transactions happening in the account, don't you?
Exactly, that's right.
So you are missing on the vital link where you have no knowledge of what is happening in the customer transaction account. It is actually like saying, I want to measure my blood pressure, it's just that I don't have a manometer. So obviously you then need to rely on other signals which in your limited environment can play, which could be only on-field signals or industry signals or the local area network signals, assuming you are in Bangalore and you are in Mysore and you are into spice trading and you figure out that the cardamom commodity rates are going down, or the forex rates are tanking, then you need to develop your systems in line with what is very relevant and pragmatic for that kind of a cluster knowledge and information. So you need to pick those, make those models and work in those frames. Because you actually don't have a manometer which measures your blood pressure, so you have to make other forms of signals. So the point here is that you have to decide for your kind of business and your kind of client, where are the signals, how do I capture them? Once you actually get to finding out these are my right set of signals, then you can worry about how to capture them. So the science is actually all about first figuring out what are the signals, where they are, and the third step is then finding a system to do that. So obviously not all systems which you may have may capture it. You have to probably build some linkages. You may have to hook on to maybe to certain source systems like where you get certain data feeds relevant to your business. So I wonder if that answers your question. But for an NBFC in India, typically speaking, depending on the business you are in, you have to generate those signals which are very relevant for your client sets.
Great. This is very, very interesting, and I'd like to offer that the two of you can connect offline, but we've gone quite a bit over our time, and so I'd like to thank again our presenters. Thank you, Amit and Manish. Thanks to all the team at CRISIL for putting this together.
And you also mentioned about
Murti, we're actually going to, sorry, the sound is a little bad, so I'm going to mute you now. But if you want to go ahead and connect with CRISIL afterwards, I can provide you with their contact information. And again, I'd like to thank CRISIL and all of our participants for staying on the line for this amount of time. And as I mentioned, we will post a question or two that we haven't been able to answer on our LinkedIn page. And please do feel free to either contact myself at the CapPlus Exchange team or Amit or Manish at CRISIL with any further questions. So thank you again to everyone.
Thank you very much, everybody. Thank you, Jessica.